The Dow takes a 2% tumble as China's stock market drops 7% overnight and oil prices fall to their lowest level in more than a decade. What does that mean for the average investor? Here to take stock of the market volatility are Brian Battle, Director of Trading at Performance Trust Capital Partners, Barbara Finder, Family Wealth Advisor and Senior Vice President at Morgan Stanley, and John Gajkowski, co-founder of Money Managers Financial Group in Oak Brook. And welcome all to Chicago tonight. Happy New Year. Thank you for being back here. First of all, Brian, a terrible first week for the stock market, the worst first week since 2008. The Dow closed down almost 400 points today. That's about 10% below its high for the last year. Is this a crisis?
So I think it's a symptom of how interconnected global markets are. You know, we had all this turmoil in China, which was caused by the Chinese. Remember, China is a communist country. It's centrally planned. And they decided they needed to lower the value of the yuan to make their goods more competitive. That was a signal that, A, maybe things aren't going as well in China as they thought. And they also instituted circuit breakers in their stock market. So remember, China's stock market is relatively new. It's relatively small. And so
25 years old or so.
Yeah, right. It's only 25 years old. So they put in a 7% circuit breaker, meaning if the stock market goes down 7%, it's closed. That happened twice this week in 4 days.
Doesn't exactly inspire confidence.
Not confidence in the stock market, and also might be a signal that the guys who are in control might not have as good a handle on things as we think.
Okay, John Gajkowski, point Brian makes about interconnectedness, but is it has this interconnectedness resulted in a crisis?
I don't believe it's a crisis situation. It's a crisis of confidence, short-term confidence, and that's what we have to be aware of. And I think what we always have to do, especially in these situations, is to always take a step back and put things in bigger perspective, not the 1 or 2 day trades.
Because Barbara Finder, one of the things that comes to mind is this another 2008 in the making? Do you see it that way?
We really don't believe it is. Rates are low, earnings are great, and there's a lot of cash on the sidelines. And if we could de-risk the portfolios or the minds of people to be a little bit more open-minded to value, which is hard to do. The hardest thing to do is to buy when things are down. We'd have a lot more confidence in investors.
Let's get back to the circuit breaker system, because that was supposed to be sort of a safety valve, so that if things got too unstable, then don't worry, we have it under control. We'll stop things. Everyone can take a breather. But that's exactly the opposite has happened.
You're exactly right, Phil. The thing that they thought would instill confidence caused panic. Because if you want to sell and you can't, you're waiting at the gate the very next morning to sell again. What's interesting about the whole thing is in 2 circuit breaker days this week, this afternoon, the guys who are in charge of the market there said, we're taking the circuit breaker off tonight. So the stock market in China, if it opens tomorrow, will have no circuit breaker officially. So that either means one of 2 things. That, wow, we're going to get some relief, it's going to go down like crazy, or they might come in and just close it again because it's out of control. It's going to be a very interesting night tonight and morning tomorrow.
But John, that doesn't strike me as someone who doesn't really follow this day in and day out as a particularly good system to be changing the rules as you go along. Doesn't that create some instability, some lack of confidence? And
it causes a lot of instability, and that's what you do. I believe we're better off with the freer markets and just letting things react the way they normally react.
Forget the circuit breakers, in other words?
The circuit breakers, again, like Brian said, they just instill more and more fear because, again, I think more people are more afraid of the unknown than what they can see on the surface. So I think it's much better to be, much more open, as much as you want it to be as open as possible.
We're really kind of a panel of electricians at this point. We keep talking about circuit breakers. Barbara Finder, remind us what the circuit breaker system is in the U.S. stock market.
In the U.S. stock market, it started right in the end of '87. We established circuit breakers if the market went down or up 7%, that all trading would stop. So now it's 7%, 13%, and 20%. Those are the 3 circuit breakers, and everything just stops and resumes the next day. And it's probably the best for the market.
And how many times have circuit breakers kicked in?
To be honest with you, not too many. They've been maybe once since '08.
So that's a good thing in terms of inspiring confidence in U.S. markets. So, Brian, let me get back to you for an explainer, because just in simple terms, why does devaluing the Chinese currency contribute to a lower stock market in the United States? Just a primer.
Sure, exactly. So there's 3 major economies in the world. There's Europe, the U.S., and China, and Asia. And so China is trying to manage its economy to a 7% growth rate, and China has been going gangbusters for 10 years, 15 years. That growth is starting to slow down. So the reaction that the Central Bank of China has, and the people that are in charge of China, has been to devalue their currency. And what that means is their goods are cheaper here. Unfortunately for us, that means the dollar is worth more, the price is higher. So goods that we export are more expensive. So that's bad for U.S. exporters. It's good for people that import things from China.
Because presumably U.S. exporters will be selling less in China because they become more expensive.
Right. So Caterpillar, Boeing, Navistar, stuff that we can manufacture here and export overseas gets more expensive.
Barbara Finder, one looks at the potential worst-case scenario, but then one also considers the fact that China reportedly has more than $3 trillion in foreign exchange reserves. Do you think that ultimately the government would step in to stabilize things?
I think they might. The biggest issue is that China does not have good communication. Their financial officials, their government officials aren't communicating, and what our clients and our investors need, and every investor needs, is good communication, transparency, which is why things work well in this country. And in that country, it's pretty haywire, it's a lot of chaos. And I think that...
Well, as Brian says, you got two systems in place,
exactly.
A communist system on the government side and a kind of a free market system on the other side, but not exactly.
Well, it's a new market, it's an amateur market, and there's a lot of retail trading on margin, which is not healthy, and that's what's causing illiquidity.
Well, John, is China solely to blame for what's happening in the stock market, or is there a bigger picture that's kicking in?
I think China is probably the biggest primer right now, but there are a lot of other things going on. The other emerging markets have been weak. Europe has been weak. The United States has done well in comparison to others, but not going great gangbusters. So there's pretty much everybody's a little bit ill at ease.
One of you told our producers that the U.S. economy was sort of the brightest bulb in a dark room, or something like that. Am I mixing metaphors here? And Barbara, spell out for us what the impact of the oil price has, again, in terms of a basic explainer. Oil prices are low. Why is that bad for the stock market?
Well, it's a great question. There's pros and cons as to everything. As oil prices are lower, it's allowing us to have a little bit more cash in our pockets to spend. Consumers are doing a bit of that. But the downside is that if oil stays low, the producers aren't going to make as much, and there could be downgrades on investment-grade debt or even high-yield debt. And that could continue and cause a recession.
Well, let's take it micro, Brian. In terms of what small investors should be concerned about right now.
Yeah, I think the small investors should be concerned if they don't know what's in their portfolio. So if you say, gee, well, I wonder why my exposure is to China. If you don't know that answer, you better take a look at your investment plan. The second thing you should be concerned about is global growth is slowing. And it's not great in Europe. They're trying to lower interest rates and devalue the currency. China's trying to lower rates, devalue their currency. And the U.S. is raising rates. That's going to have implications. And it's unusual to have central banks not acting in concert. So individual investors should know what their exposures are domestically and in foreign sectors.
Barbara, what advice do you have for small investors right now?
Small investors should make sure they're properly allocated, rebalanced, not be afraid to keep cash. And I think things are going to get pretty reasonable very, very soon.
Really? Very soon? John, do you believe that things are going to get better pretty quickly?
I agree that the long-term outlook is still very favorable. And I believe, people do have to be aware of their portfolio, and diversification, especially during crazy times like this, is the real key. And what you want to do is have cash to make sure that you can carry through these rough times.
Got it. But one of the old cliches is, if the market is down, it's a great time to buy. Is it a good time to buy?
The other old saw is you're trying to catch a falling knife. So that sometimes that doesn't work out so well.
Or swimming towards a sinking ship.
That's right. But Warren Buffett, a guy that has a pretty good idea of how to do this, has said, be greedy when others are fearful. So this is a great time to keep your head and don't be a trader, be an investor. So my caution would be know what you own and make sure that you have a long-term plan and are prudently following it. And the headline is, oh my gosh, the stock market's falling apart. If you're reasonably diversified, your bond portfolio is doing great.
Yeah, I was going to ask you, should bonds be more appealing now, panelists?
Sure.
Or electricians?
Yeah.
To a point.
To a point?
Yes. We believe that the very short term and the very long term look attractive, but the first part, or the shortest part of the curve, is going to be the most volatile. And if rates don't go up, the longest part of the curve is going to be the most attractive.
How about savings accounts? John, are they going to have new life, new attraction?
I think you'll see some changes in interest rates because of the Fed ticking up. I don't think it's going to be significant. So people just have to be really, really aware of where they can put their money. There are other alternatives, other safe alternatives, short-term alternatives available. You can do short-term annuities. You can, most people are telling our clients, go from your local bank to internet banks. It's not a big difference, but 3/4 of a percentage point in your pocket is better than anybody else's.
Yeah, and I think the thing that we all have to remember is it's impossible to call interest rates. You don't know if rates are going to go up or down. But the thing you can do is say, boy, what will happen if interest rates go higher or if they go lower? So get some scenarios to say, boy, if rates go up 500 basis points, am I going to be okay? And then if rates aren't unchanged, am I going to be okay there? So make some judgments so your portfolio is all weather, no matter what happens to interest rates. Because the temptation is to think that interest rates are going to rise. And everybody's been saying that for years, and it hasn't happened.
All right. Well, let's look at the elephant from a different perspective, and that is, speaking of elephants, the presidential election. Does a presidential election affect the stock market in terms of just creating a general sense of instability?
We believe historically that there's been a positive bias for the years of presidential elections.
Really?
Yes.
Explain that.
That's just the way it's historically been.
And that seems counterintuitive.
Yeah, I think part of that is the Federal Reserve tends to not be active during a presidential election. I think this election is going to be very interesting because the Federal Reserve is raising rates during an election year, which is unusual. And if you had to bet today, it would be Donald Trump and Hillary Clinton would be the nominees. The stock market will start discounting who's going to win once we get past the conventions, because most presidential nominees talk to their base, they get the nomination, and then they get to the center. So maybe sometime this summer, you'll see the stock market starting to bet on who's going to win or who they think's going to win, because I would believe that the market would deem as Donald Trump to be a little bit more pro-business than Senator Clinton.
Do you agree with that? Is the chattering class in your profession, are they thinking Trump is going to be the nominee at this point?
We haven't an opinion yet. It's too early.
Pardon me?
It's too early for us.
I see. But is there a consensus that's forming as to who the nominees might be?
I don't think there is a consensus yet. I think it's still pretty wide open. But it's going to be very interesting, and because of the interest in it, I think there's going to be continued volatility because, again, people do not like instability or not knowing what's going on.
That's where we'll have to leave it. Electricians of choice. Brian Battle, Barbara Finder, and John Gajkowski, thank you all for being here.
Thank you.
And Happy New Year.
Thank you.